2020 has been a year no one could have predicted. A global pandemic, social unrest, devastating natural disasters, a contentious election cycle, and market gyrations of every kind. To make sense of it all, I've asked Chip and Matt to share Westover's economic and market outlook for 2021. This year we've decided to do something a little different. We're presenting this perspective in a short video format, and we hope you will find our assessment both informative and thought-provoking. We also look forward to your feedback and to getting together virtually or in person to review your specific portfolios, to discuss what's on your minds, and to provide you with our very best thinking and advice. But before I turn it over to Matt and Chip, I wanted to give you a few thoughts. As I look back on the last year, we were all faced with many new, different, and unique constraints. These challenges often drove us to create new ways of thinking and acting. We needed to think differently. We needed to innovate to meet the ever-changing needs that this new environment we found ourselves in demanded. Day in and day out, in good times and in bad, we continuously challenged ourselves to deliver the finest investment management and wealth advice we could to you, notwithstanding this horrendous coronavirus overhang. Some other thoughts. From the day I founded Westover in 1999, I've sought to create a client-focused wealth advisory firm that served our clients the same way I cared for our own family. As I grew the firm, I knew that I would need to reach out to bring someone else in to help me with the investment research, the management, and the trading that was required. I was fortunate to find someone with superb academic credentials who also had a very deep experience in both trading and investing. It was also important that he happened to share my views on markets, on investment, and on other matters of wealth generation and capital preservation. Of course, it didn't hurt that his last name and mine were the same. Chip's been with Westover now for over 10 years, having joined us in 2008. He's done an outstanding job as our CIO, and he continues to lead our firm's investment strategy and research. As Westover continued to grow, Chip and I knew that the next hire would be critical. We knew that we needed an experienced person, one who shared our views on client relationships and who complemented our skill sets. We found that the ideal person would expand on our strengths with those that he held. So we didn't undertake that search lightly. And fortunately, we found exactly the right person when we hired Matt Beardwood in 2016 as our Director of Wealth Management Services. He brought with him deep experience and expertise and strengthened and coordinated the delivery of wealth management advice for all of our Westover families. Matt continues in that role today, and he continues to work closely with Chip to develop and implement strategic initiatives which enhance the Westover client experience, and he continues to execute our collective vision for Westover today and in the future. Part of that collective vision is to provide you, our clients, with holistic wealth advice that includes investment management, wealth management, and tax consultation. These are vital, interconnected components that deserve equal attention and representation. To deliver on that vision, Matt, Chip, and I welcomed Dennis Perdue as Westover's new Director of Tax Services in November of 2020. Dennis has been doing my personal and business tax returns for many, many years. We all agreed that we had found the right person for this vital role for Westover. He joins our team with over 20 years of experience in accounting, consultation, tax services for individuals, families, small businesses, and for foundations. And so the story continues. This year has tested all of us in new ways this past year. Times like these have a way of shining a light on the blessings we have in our individual lives and allow us to focus on what matters most. At Westover, our success is measured by yours. We're grateful, and we thank you for the trust you've placed in us. We look forward to 2021 with great optimism, both for the country and for each of you. Take care.
Happy New Year and welcome to Westover's 2021 Economic Market Outlook. My name is Matt Beardwood and I'm Director of Wealth Management for Westover Capital Advisors. Joining me today is Westover's Chief Investment Officer, Chip Sawyer. In this presentation, Chip and I will share our economic outlook for 2021 and how it could affect markets and the economy going forward. Chip and I have put together a brief agenda here that I'll share with you. I'm going to kick things off today by providing an update on the COVID-19 pandemic. I'll turn it over to Chip to talk a little bit more about the economy and the Feds. We'll take a little deeper dive into markets, asset valuations, and volatility. We'll talk a little bit about Biden's economic and tax agendas going forward, and then wrap up with some final thoughts. So with that, we'll get started. I think it's important that any discussion of the economic outlook begin with an understanding of the human toll of the pandemic itself. As you can see here on the slide, globally, we are at almost 103 total confirmed cases. Corona is spreading in over 190 countries, and we have about 2.2 million deaths currently on record. And although the conditions of the pandemic around the globe are improving in many areas, the fact is that the virus is continuing to surge in many countries, particularly a lot that have had success suppressing initial outbreaks. It's clear that the World Health Organization has made comments that we will continue to see problems with COVID, and the worst may be yet to come. When looking more closely at the United States, the situation here in our country is improving, yet the damage is pretty severe. We have over 25 million confirmed COVID cases, over 430,000 deaths. Hospitalizations, although coming down, now exceed 100,000, and that's twice the rate that we've experienced in either of the two surges. And to put this into some kind of perspective, the U.S. has now recorded more COVID-19 deaths than the number of Americans killed in combat during World War II. Recent projections suggest that within the next month or two, deaths may surge in upwards of 650,000, and that would exceed the total number of servicemen and women lost in the last 100 years of war. Having said all of this, there is some good news as we enter 2021. After several weeks of spiking hospitalizations, cases, and deaths, we're beginning to see a plateauing and even a decrease in those numbers. After hitting record highs earlier in January, the 7-day cases and deaths are starting to drop, and that's the 7-day averages. With two very effective vaccines in the market right now, two more that are about to become approved by the FDA, and about 9 different vaccines in phase 3 trials, this should all lead to improving conditions in the U.S. as we continue to get more vaccinations in people's arms. Having said all that, there is still a long way to go. Slow vaccine rollout initially, along with the new variants of COVID, require us all to continue to follow the CDC's guidelines. Those are wearing a mask whenever we are out in public, 2, social distancing, 3, avoiding large crowds and gatherings, and 4, continuing with aggressive hand washing. These are the things that are going to help us stem the tide until the vaccine is completely rolled out. My hope is we'll get this pandemic under control, get the population at large vaccinated, and return to some normalcy as we approach the latter part of this year. Now, having said all that, it's been a challenge, and Chip, I know that the picture I've painted here is not great, but there is a concern and cause for good optimism. Tell us what you're seeing in the economy and the markets as we go forward.
Yeah, the next slide is going to show you the dramatic effect that the pandemic had on our economy. This chart showing you potential GDP in green versus actual GDP in black. And you can see that we basically fell off a cliff there at the beginning of the pandemic when we shut down the economy. But you can also see that we've made some recovery since then. And that's a good sign for sure. But we're not going to be able to get back to that green line of potential GDP until the entire economy opens up. As everyone knows, the hospitality sectors of the economy, whether that's restaurants, travel, entertainment, they're still in shutdown mode. And we're not going to get back to full GDP until we can open up some parts of the economy like that. The next slide is going to show the S&P 500 versus GDP. And I think one of the most perplexing contradictions of 2020 was the stock market's performance in the face of this global pandemic. There's a glaring reminder that the market and economy, while related, are not identical twins. The market's always looking past the current environment and trying to predict how the future will look. And it's just as influenced by investor sentiment as it is by corporate earnings. So in the zero interest rate environment that the Fed produced, investors continue to have a voracious appetite for stocks. So it's just a reminder that the headlines you read about the economy don't always translate to the performance of the stock market.
How about the unemployment outlook?
Yeah, so as you know, the economy shed about 22 million jobs in the beginning of the pandemic. So it was a devastating effect on the unemployment rate on the labor market in general. You can see that on this chart, the grayish line. You can see that huge spike in the unemployment rate. Whereas right before the pandemic, we had the lowest unemployment rate we'd seen in decades. That quickly changed in the face of basically a 2-3 week period. We have recovered the majority of those jobs. We still have some work to do, as I talked about before. It's really the hospitality parts of the economy where we're really struggling to replace those jobs. Until we can get those guys back online, we're still going to have a higher unemployment rate than we want. The other line on this chart, though, I think shows an encouraging picture, and that's wage growth. That's the blue line there. In general, it kind of acts as a counterbalance to the unemployment rate. But you can see that the trend that was in place before the pandemic was a steadily increasing growth in wages. And that's a really good sign. That trend has continued even through the pandemic and as we're recovering. So I think that's a really good sign, especially as we reopen the economy in the second half of the year. That should really help things.
Yeah, it's really interesting that how uneven this economic downturn has really been. You touched on it a minute ago. In some areas of the U.S. economy, it's really reached depression-era levels. Again, the hospitality, restaurants, hotels, airlines, and perhaps hardest hit of all, the thousands of small businesses that have closed and may never come back. But for other areas of the economy, it's literally been the best of times. Technology, certain areas of the healthcare sector, e-commerce, cloud computing, even the home improvement stores have skyrocketed in this new stay-at-home era. I suspect the post-COVID U.S. economy is going to be very, very different than we had this time last year. It's going to be more efficient, more dynamic, and I suspect there'll continue to be a number of evolving winners and losers. So, Chip, we haven't really talked much about the government response. Can you touch on that a little bit and the Fed outlook?
Yeah, absolutely. So the next slide is going to show monetary policy, basically what the Federal Reserve did in the face of this pandemic, and you can see there was a dramatic response. They dropped the Fed funds rate to 0, and they injected about $3 trillion into the economy. They also adopted a new policy about inflation called average inflation targeting. That's different than their policy before, where basically they targeted a 2% inflation rate. And the idea was if we ever could get to that 2% inflation rate, the Fed would kind of draw back on their stimulus. Where now with this new policy of average inflation targeting, they've clearly made it a priority that they're going to let inflation go above 2% for a long period of time. They're going to keep rates lower for longer. And that's going to have a dramatic effect on both the stock market and the economy in general. The economy and the markets both like low rates. And so this is very encouraging to market participants because they're thinking that the Fed will not raise rates too quickly. In general, that's a good thing. The one risk to that, of course, is inflation, which I'll talk about a little later. The next slide is going to show you the yield curve, and all we're looking at here is where our short-term rates versus long-term rates. You can see on the left-hand chart, that's what the yield curve looked like at 3 different periods of time. That is the beginning of 2019, beginning of 2020, and now. And 19 and 20, those are the lines at the top there. The yield curve was flat, meaning short-term rates and long-term rates were pretty close, whereas now you can see the curve has steepened. We even got what's called an inversion in 2019. That's when short-term rates are higher than long-term rates. It doesn't happen very often, but it's been a very accurate predictor of recessions. The 7 prior times that happened, we got a recession shortly thereafter, and sure enough, we got a recession about a year later after the curve inverted in 2019. But what you typically see with an economy coming out of a recession is that steepening yield curve, which is exactly what we're seeing here. So this is an encouraging sign. It's generally a sign of a healthy or improving economy. It's a good, it helps banks out a lot because they borrow on the short end of the curve and lend on the long end of the curve, so it helps their profit margin. So in general, that's a good sign. It's encouraging to us that that we're getting through the recession and on the way to recovery. Let's see. So let's talk about inflation a little bit. So for the past decade, the Fed's been trying to get inflation to come up above this, or get to their 2% number that they're looking for, their target. They haven't had a whole lot of success. You can see on this chart that's covering CPI that inflation's remained stubbornly low for the past 10 years, despite their zero interest rate policy. I think things might change now. They've been very aggressive with stimulating the economy. And of course, we had a similar response from Congress. So we have both monetary stimulus and fiscal stimulus. We had a huge stimulus package in 2020 in response to the pandemic. We have another one that's about to be signed here in 2021. And so the next slide is going to show you kind of market expectations for inflation. So whereas the previous slide was what is the actual current inflation rate, the next slide tells us, well, what does the market think about the future inflation rate? And the blue line there is basically the difference between nominal treasuries and inflation protected treasuries. And when it's going up, that means that the market is expecting inflation to increase. And you can see we've had a pretty significant move up since the beginning of the pandemic. And I expect that probably will continue. Like I said, we've had a massive monetary and fiscal stimulus. We have an economy that's not quite open yet. So when it finally does get open, there's going to be a large demand for services. We're talking about maybe an increase in the minimum wage. I talked about before how wage growth is improving. So all that could add up to a slightly inflationary environment. In general, that's good for stocks as long as inflation doesn't get too high. It's generally not good for bonds. So this is definitely something we're keeping an eye on.
How about the earnings outlook?
Yeah, so as you'd expect, the pandemic had a dramatic effect on the market's earnings, on the S&P 500 earnings growth rate. And this chart shows you the serious decline that we experienced in 2020, but it also shows you the potential for recovery. So the prospects for 2021 are pretty good. As we get vaccinated, as the economy slowly reopens, we should have pretty good earnings growth, which should encourage the market to go higher.
So the earnings outlook is strong. We've seen the markets here react recently. Are stocks getting ahead of themselves? Are they getting too expensive?
Well, they're certainly expensive relative to their own history. You can see that in the next chart, which is tracking the PE ratio, or price to earnings multiple of the market, going way back to the 90s. And you can see we're basically as expensive as we've been since the dot-com era. So relative to their own history, stocks are expensive. Now, there's a huge difference between interest rates now versus then. Back in the dot-com era, rates were 5, 6, 7%, whereas now I talked about they're basically between 0 and 1%. So lower interest rates support higher multiples. So that suggests that the stock market maybe isn't that expensive right now. This is something we're keeping an eye on. Your best defense against a expensive stock market is to have a diversified portfolio, which is what we do. You know, we diversify across all sectors. We diversify across size and style of stock. And of course, most of our accounts are balanced, which includes the bond side of the market. So I think that if I had to pick the most expensive asset class right now, it would be bonds. So as an investor, you're still probably better off owning stocks rather than bonds. I just think that stocks are cheaper than bonds. That being said, this is something we're keeping an eye on as well, because we'd rather buy cheaper stocks than more expensive stocks. And because we pick individual stocks, we can try to do our best to do that.
Got it. How about the volatility picture? It was certainly a choppy year last year with that early bear market and then bounce off of that later in 2020.
Yeah, it was an historic year for volatility. The market, the S&P 500 at least, ended the year up 16%, and yet it included a 34% drawdown during the year, which is a dramatic performance for the market. So this chart here is showing the annual returns going back to 1980 for the S&P 500. That's the gray bars. And then within each of those years, those red dots represent the biggest intra-year decline. So This is if you had the worst timing ever and bought at the high, sold at the low, how much money you could have lost. And while the market itself returned about 9% annually over this long period of time, 41 years, the average intra-year decline was 14%. So if you had bad luck or didn't have the stomach to handle a correction and you'd sold every time there was one, you would have lost a lot of money. But if you were willing to brave the corrections that are part of investing, you could have enjoyed a very healthy return. So this is what we call the price of being an equity investor. You just got to stick through the hard times so that you can basically enjoy those long-term returns. If you'd invested $1 in the S&P in 1980, I think it's worth almost $35 today. So despite all that volatility, despite some down years, despite an average of a 14% intra-year decline, long-term investors did very well.
Yeah, I guess it's very tempting to go to cash when the markets get really volatile. And this next chart, I think, just kind of illustrates the point you're making there, but in a little bit different way. This chart shows the growth of $10,000 invested in the S&P 500 for the period from January 2000 to December of 2019. And if you look over to the far side, that far side bar on the left shows the return of a fully invested portfolio in the S&P 500, which averaged over that period about 6% per year. However, missing the 10 best days in the 20-year period drops the return by more than half, drops it down to 2.4. And as you can see there, the results only get worse as more good days are lost. It's interesting too to note that, while it's true that many of the worst performing days occur during bear markets, so do many of the best performing days. And trying to time that and time the market without missing the top days is really a challenge. It's very difficult to do. So, as Chip has alluded to earlier, the best thing for investors is to stay invested, a diversified portfolio, and stay focused on the long-term goal. How about the next chart, Chip? This is one I know that you like to talk about in these long-term trends.
Yeah, so this is a chart we've used for a number of years now. It's one of my favorite charts because it does indeed show the long-term history of the markets and these long-term or secular bull and bear markets that the market experiences. So this chart goes all the way back to the early 1900s. And it shows these long-term secular bear markets, which are the red lines. They average about 14 years long. The average secular bull market lasts about 20 years. And you have very dramatic differences, of course, in the returns of the market during these periods of time. So most people know that the average return of the market is about 8% over long periods of time. But how you get that 8% isn't how you might expect. That is, during these bear markets, you don't make anything. So you invest $1, 14 years later, it's worth that same dollar. Versus during the bull markets, you invest $1 and you make 15, 16, 17% annually for 20 years. So you average those out and you get your 8% return. So we think that where we are now is we're still in the midst of a secular bull market. You can see that at the right-hand side of the chart there. We think it started in 2013, which is when we took out the previous bull market's high. We still think we have some room to run. And so the other thing to remember is that we've had some pretty strong market years recently. Over the past 10 years, we've had some really good years. But that's what you get in a secular bull market. We shouldn't be surprised that we see 15, 16% returns, because when you're in a secular bull market, which I think we are in right now, you get these strong returns. So this is just another reminder, you got to stay invested when the market's doing well, because once we reach the next secular bear market, it's not going to be a lot of fun.
Great, thank you. I'd like to take a moment and pivot now and talk about the other significant event to occur in 2020, and that was the election. Shortly after Biden was declared the winner, I sent a video out to clients about end-of-year planning, and I encouraged clients to plan but not act until we had more certainty on the outcome of the congressional election specifically. And now we're there. We know what the results of the Georgia runoff are, and now the Democrats have effective control of both houses of Congress, as well as the White House. And that really gives President Biden a clear path to enacting his agenda. Now, I'm of the belief that we're not going to see any major tax changes right out of the gate. Washington clearly has more pressing issues and concerns to worry about right now. However, if we see a sharp turn in the pandemic, conditions begin to improve, I wouldn't be shocked to see some of Biden's economic and tax policies come up onto the agenda, on the congressional agenda. And that would be larger issues other than COVID stimulus bill and some of the economic components in that. So when looking at Biden's tax policy, there's certainly a lot to unpack and way too much to cover in this presentation. So I want to highlight on a couple of things, but before I do, I want to make the point that most of Biden's proposals are really targeted, either one to high income earners making over $400,000, to expanding tax credits and deductions to those families with lower incomes, and to targeting wealth transfers, particularly those larger estates. This slide highlights three items I want to take a deeper dive into, and I think maybe in addressing these, it makes more sense to ask some questions. One, as it relates to income, what ability do individuals have to control income and deductions in any given tax year? Based on Biden's campaign pledge not to increase taxes on those making less than $400,000, the timing of income and deductions is going to be key. Secondly, do taxpayers have plans to sell any significant assets? Biden's campaign proposals would increase tax on long-term capital gains to nearly 40% for those earning more than $1 million. Now, you might be saying to yourself, I don't make $1 million. However, the sale of a major asset could trigger one-time income over $1 million. Major assets would include things like business interests, investment properties, and the like. And again, the timing of these sales may be an effective tool in mitigating capital gains taxes. Let's talk about wealth transfer a little bit, because Biden has discussed two significant changes to how transfers of wealth are taxed. First is the gift and estate tax. Biden has talked about reducing the federal gift and estate tax exclusion amounts, that is, the amount that can be passed to heirs free of tax, from about $11.5 million to as low as $3.5 million per person. Now, that's still a lot of money and may not affect a lot of families, but it's certainly going to bring a number of estates back into the picture. And what's more, some Democratic proposals include returning to a system in which a portion of the estate and gift tax exclusion gifted during life would be limited to $1 million, making it difficult, more challenging to transfer assets during life. The second important factor was Joe has talked about eliminating the current law regarding the step-up in cost basis at death. Under current rules, assets included in a deceased's taxable estate receive a new cost basis for tax purposes, which is equal to the fair market value of the decedent at the time of the decedent's death. This eliminates a lot of the appreciation and can reduce or eliminate capital gains entirely when the assets are eventually sold. Biden's proposal would cause an asset's cost basis to be carried over from the decedent to the heir. And in a further twist, some proposals are calling for a tax to be triggered at death of any unrealized capital gain, regardless of a sale. Now, that's significant. If the repeal of the step-up basis rule could affect anyone inheriting appreciated property, regardless of income level, and it wouldn't be just the wealthy. So to sum up, these proposed, and there's several other proposed tax changes out there, but the ones that we've talked about here are both broad and complex. And it's really important for individuals to consider potential precautionary steps. There are a variety of factors that come into play, and ultimately the decision on whether to act on any of these proposed policies is really up to you. But these are the things that we can help you with on the planning side. And we look forward to discussing these issues in more detail to make sure that you're making the most informed decision. And that takes us to our final slide here today. This famous motivational slogan, "Keep calm and carry on," is probably recognizable to many of you. This was produced by the British government in 1939 in preparation for World War II. And it was intended to raise public morale as citizens faced the threat of mass air attacks. Now, we're not facing a traditional war now, but it sure feels like it as we battle COVID in our daily lives, not to mention the economic and market volatility that we've had to endure. It's times like these that can be easy to lose our calm, but it's critical that investors focus on their financial goals, avoid those emotional biases, and stick to the plan. Thanks for watching our 2021 Market Outlook today. We welcome your comments and look forward to meeting with each of you, either in person or virtually, to review your portfolio and address any of the topics that are important to you. Thanks again, and please continue to stay safe and healthy.